Hello, everyone. My name is Andrew Stotz, and I want to welcome you to this event sponsored by Phenomena. And we're going to be talking about the all-weather strategies that we do together with Phenomena. There's a lot of things that we're going to go over tonight, including some changes in the allocations that I'm going to talk about. And also, we've got a change in the benchmark. And I'm going to explain why I'm making this change. Most importantly, I want to welcome everybody to ask questions. Any question you have or any idea that you have going on in your head about global investing, now is the time to talk about it. Now is the time to ask questions, and I'll do my best to answer those questions. So let's kick it off. I'm going to share my screen. And I'm going to go into the presentation. 1 second. Let me do that. And I'm going to, here we go. So we're going to be covering the all-weather strategies for August of 2023. Before we start, I just want to mention that we have an event happening on Sunday called Sunday Coffee with Phenomena, sponsored by CoffeeWorks. For those of you guys that know me, you know that I'm a co-founder of CoffeeWorks, and I told Phenomena and I told my business partner Dale, hey, CoffeeWorks ought to sponsor the Sunday Coffee Talk, where I'll be presenting strategies and other stuff about the portfolios and performance. The most important thing I wanted to mention was that I'm going to be live at CoffeeWorks Experience Center, which is at Sukhumvit Soy 26, right across from K Village. And so we'll have more information that we can share here, but you're welcome to come down and meet up and learn about what's going on and, get to know each other. So remember, ask questions in the chat. I love your questions. Even the tough questions are great. Now, remember, our strategies are global, long-term, and diversified. That's what we're trying to do. And remember why we're here. We're here to build wealth. We're not here for some fancy trading strategy to try to come up with the next big idea. We're trying to slowly, steadily build wealth over time, over the long term, because it's a marathon, not a sprint. Now, there's 3 pillars of investing as I see. The first is to be broadly diversified. The second is to contribute regularly. And the third is to stay invested and let your money compound. I discuss this and many other things in my 12 steps to financial independence. Let's talk about it. Create a plan. Keep investing simple. Start early. Get realistic about stock market returns. Do it yourself. Avoid mistakes when you're young. Build wealth through savings, keep financial costs low, diversify to reduce risk, own both stocks and bonds, trade infrequently, and stay invested and watch your money grow. Those are the 12 steps to financial independence that I talk about in my book, How to Start Building Your Wealth, Investing in the Stock Market, which is available in both English and in Thai in bookstores. And also we have an online course at academy.astotz.com. Now, our goal is to deliver steady returns over the long run. This is a picture of our 3 portfolios. The all-weather strategy was launched in February of 2019 and targets a 6% per annum return. All-weather Alpha Focus, the blue line that's been through some pain when it started, but kind of been flat recently, was launched in October 2021 and targets 8% per annum return. And then there's the all-weather Inflation Guard, which was launched in July 2022 and targets 4% return. As you can see, the green line is the least volatile and the blue line is the most volatile. So those are our goals with these 3 strategies. Now, from when we started all-weather Inflation Guard in July of 2022, the strategies are performing almost as expected. Moderate risk AWS has had the highest return, and highest risk Alpha Focus ranks lowest. It can happen due to higher volatility. As you can see, the blue line, the alpha focus, is the most volatile of it because it's the highest risk. You may say, oh, Andrew, but I'm not getting great return right now on alpha focus. But remember, alpha focus is to try to capture the upside. And all weather inflation guard has the lowest volatility. You can see that green line is relatively flat. Now, since 2022, all strategies are below world equity, but with lower volatility. World equity has been on a tear. If you were just investing on your own in global world equity, you would have done very well. Now, remember that world equity is not after fees, but the all weather strategies are all taken after fees. So that's what we see there. Now, we create our strategies for many decades. However, not even a decade is long term. That's me when I was a baby. That's me when I moved to Thailand. And that's me when I turned 100. Our aim is to create strategies that perform over many decades. So we're going to go through a bunch of stuff, but first we're going to go through the performance of the all-weather strategy, which was down 1.8. It was a tough month for all strategies. Now, before we go into the performance review, in March 2020, you remember how the stock market completely crashed. We decided to allocate the Thai money market instead of global bonds to reduce our COVID crisis risk exposure. We were worried because high-yielding bonds spreads over low-risk government bonds were exploding. And in fact, the fund that we were invested in was a TMB fund here in Thailand that ended up closing and not allowing redemptions for a period of time until eventually it reopened. So we got out just in time and we put our money into safe TMB treasury money. So we've decided to return to global bonds and move our bond allocation to SCB Global Bond Fund from TMB Treasury Fund in All Weather and Alpha Focus. In Inflation Guard, we switch our core bond allocation to SCB Global Bond Fund from K Bond Fund. So now all of our bonds are now Global Bond Fund. So as a result, we also change our benchmarks. Our benchmarks that we've used for the strategies have used the Thai money market for the bond allocation since March 2022. Since all our strategies aim to have a global focus, we have revised our benchmarks since inception with regard to bond allocations. FTSE World Government Bond Index is now used for the bond portion. Now, let's look at our goals. We're trying to be global, we're trying to be long-term, and we're trying to be diversified. Here we can see that since inception, the all-weather strategy was up 26.8%. And if we look at the 60-40, now 60-40 using the global bonds in the index, we can see that we're about 11% above a 60-40 portfolio. In August, the strategy was down 1.8%, which was 0.9% above the 60-40 portfolio. So though we were down, we did a little bit better than the portfolio. Our 25% Japan allocation did really well. And our 25% gold allocation kept up better than most equities. And our 25% target allocation to developed market was a drag on the performance. Luckily, we weren't in emerging markets and Asia Pacific to any large degree. Ladies and gentlemen, it's time to announce our new allocations to all-weather strategy, and here they are. We raise equity to 85% and we reduce gold to 5%. We maintain our overweight to developed markets, developed Europe and Japan within equity, and we raise US to 25% from 5%. We switch to the global bonds from Thai money market, and as I say, we reduce gold to 5% from 25%. A lot of changes there. One of the biggest ones is the move into the US. We're still underweight the US because just going up to a 25 weighting doesn't put it up to where it is in a market where if you look at a market cap index, The US is somewhere between 50 and 60% of that market cap global index. So we're still relatively low. But I think there's some chance that we see some short-term move in the US market. Also, there's a potential that the Fed comes in. So the point is, just before I move on from that, is that hold on one second. We raise our target allocation to 25% from 5%. The US is then about 30% of our total equity allocation, which is significantly below the 62% weight in MSCI All Country World Index. Now, I'm going to stop there just for a second, just because it's a lot of talking, and I would like to see if we have any questions. If we don't, oh, there's trouble. All right, let's say hi to everybody. And here, I'm just going to show some of these and maybe answer some. ABB says, hello, Ajahn, fourth quarter, bull market coming with overweight US market. I'm not convinced it's a bull market, but my weighting in the US was down at 5%. And so I'm just nervous that I'm too underweight the US. All right. And here we see Pia Pawn says, hello, I saw AWS overweight in US market. Do you have a concern about US debt crisis? Remember, I'm not overweight in the US market. I'm still underweight US. I was just extremely underweight over the last 6 months or so. Of course, the US has a debt crisis that's going to grow over time, but the US has the ability to print money from the Fed to buy up all of the government bonds that are issued. Now, eventually, that will cause a collapse in the US dollar, but that collapse in the US dollar won't happen for a while. Why? Because US has the gun, US has the military, and they can force anybody to use the US dollar. So though I am concerned about debt, and I am ultimately believe that debt will, the debt problem will show itself in the currency, I don't think that that's a short-term concern for me right now. Save more and invest better. Yes, ABB, that's right. And here we see Pia Point says, how about US REIT trends? Which factors will make it come back? Well, the first thing is you may notice that I rarely own REITs. And one of the reasons is because REITs have a very high correlation to the overall US market. And with a very high correlation, it doesn't really add much value to the portfolio. Occasionally, you'll see me in REITs in Alpha Focus, but you'll never see me in REITs in AWS. Now, let's talk about what's happening in the property market in America. Right now, the property market is in a lot of trouble, particularly the commercial property market. And I think that probably is going to be what really puts pressure on the banks. So I don't see a comeback in REITs right now. All right, Chris says, Chris LTK, hi Andrew, for US CPI, which economic number is crucial to forecast CPI projection? Wage growth, PMI, or what else? The number one, Chris, the number one thing to forecast US CPI beyond anything else is oil price. CPI has been coming down, but if oil price continues to rise, it will feed through to CPI. So good question. Rainer, Michael, good to see you. Soft landing is now consensus. I would say yes. Consensus is soft landing. So I think that consensus will probably be proven wrong at some point, but yes, I agree with you. Supergorn says, thank you for reduced gold from allocation. It is the right timing. You're welcome. Let's hope it's the right timing. I do my best by using the FVMR framework. Let me go back into the presentation. Please make sure that you ask questions and share your comments. I love to go through those, and I will be going through them again. So Let's talk about Alpha Focus. It was down 2%. It's global, it's opportunistic, and it's long-term, and it's defensive. Now, since inception, the strategy was down 11% and 2% above a 60-40 portfolio. And here we can say it was 0.4% above world equity. Ultimately, in August, the strategy was down 2%, which was 0.6% above the world equity and the 60-40 portfolio. So we did okay in this period. The strategy was 1.1% above world equity. Out of our bigger tilts, bonds, healthcare, and gold were the best performers in August. Ladies and gentlemen, it's time to announce our new allocations for Alpha Focus. Here we can see we keep equity at 68%. So Alpha Focus is actually a bit defensive right now at 68%. Within equity, we moved 3% to Latin America from precious metal miners. And we switched to global bonds that I talked to you about before from Time Money Market. And the remaining target allocations stay the same. So now let's look at all-weather inflation guard, which was down 0.3%. Remember, this is global, long-term, and defensive. So here we can see that since inception, the strategy was up 1.4%. And since inception, also, it was 2.3% below a 40-60 portfolio. So it was up, but not as up as much as the 40-60. The strategy has experienced less volatility, though, as you can see from the red line, is a lot less squiggling. And here we can see the strategy was down 0.3% in August, which was 0.9% above the 40-60 portfolio, which is in blue there. Bonds and tips especially did well as equity fell. The World Equity Fund we use in the strategy outperformed the MSCI AC World Index during this period. It's time to announce our new allocations for Inflation Guard, and here we can see that we keep equity at 25%. We changed our core bond allocation to global bonds from Thai corporate bonds in line with our global strategy. And we reduced tips and gold by 5% respectively and moved that to global bonds. So now, if there's any question, I'm going to stop for a moment and feel free if you've got any questions to put it in the chat and I'll do my best to try to answer it. Let's see what we got here. All right. So ABB says UK, EU, concession is still coming this year. I think there is going to be, we're already having some recession in Europe. And I personally think we're going to see a recession in the US. Shalom Pat says, in AWS, you have 5% in emerging markets and 5% in Asia ex Japan. Don't you think it's redundant for the position in China? Yeah, we could, it is a bit redundant. There is some redundancy. We've done this for a long time using these two instruments. It's a challenge with the idea of trying to have as few ETFs or mutual funds as possible. So I go back and forth on it. But we are working on something that could be interesting, which I'll call Asia ex China. And that's something that we can look at. But I appreciate your comment. And I do think that you're right. There is a little bit of overexposure or redundancy. But at this point, I'm not going to make any changes. But we will be looking at the portfolio again in a few months. So good point. Narong Chat says, is your positive view of U.S. market the long-term view more than 1 year? It's such a hard question, Narong. The thing about the U.S. is that the market's a bit expensive, but it's really the tech companies that are expensive. The non-tech companies aren't that expensive. And no corporates have borrowed money. I wouldn't say that they're extremely overextended as far as their debt to equity. And overall, they're well managed. So I would say that I have to say that I'm positive the US over the long term. I think where the biggest risk with the US comes is the currency. If you think the market's going to go up 10% in the next 12 months, but you think the currency is going to go down 10%, then you didn't make anything. Now, most of our funds are hedged, which means that you're not going to lose if the dollar is falling. And that's a major difference than if you tried to copy the strategy that we do through your broker and buying ETFs. The one thing that you can't copy easily or cheaply is the hedging positions on the mutual funds. This goes back to many years ago when the government allowed foreign investment funds or feeder funds for Thai institutions, but they were worried that Thai investors may not pay attention to the currency risk, and therefore they generally pushed the mutual fund companies that were doing the foreign investment funds to hedge their positions in US dollar. And that's the history as to why that's there. That was a long answer, Narom. Rayner says time in the market versus timing the markets. Exactly. We want to make sure that we're staying in the markets as long as we possibly can. We're talking decades. Petropan says, so there's no more big correction in the US market in your opinion. Again, it's a difficult one. I mean, it is such a difficult time in markets. I think it's possible that we go into a recession. And when the recession happens, the US stock market will fall, as it does in every recession. But I also think that the Fed is going to come in and try to save the day. And when the Fed comes in, it's going to cause the US market to rise again. So it's hard to judge exactly where things are going to happen, but that's my view as to what it's going to be. Yes, Jarvis says, what a nice coffee. Amen. Coffee Works is great. And hopefully we'll see some of you guys there. Kunatip says, how about India in the FEMR model? India does not yet come back up as attractive right now. And that's the reason why we're not in India in the all-weather alpha focus. So right now, it's still not that attractive. Ducit says, any reason why percent allocation in stocks in AWS is higher than in all-weather alpha focus? I think the first thing you have to understand is that we developed all-weather alpha focus and all-weather strategy completely separate with very different ideas on how to get performance. In the case of alpha focus, we built a lot of defensive positions in the stock market. But we also have a timing element in alpha focus. We don't have a market timing element in all-weather strategy. So what does that mean? When the markets appear to be overvalued or overbought, what happens is there's a switch in alpha focus that says go defensive. And therefore, our total equity weight in alpha focus comes down. We don't have that type of mechanism in all-weather strategy. And that's the reason why you can see some discrepancies. We've never tried to match these strategies. We've just said that alpha focus is targeting a higher return of 8%, and all-weather strategy is targeting a return of 6%. Hopefully that answers the question. Now, let's get back to more research that we've been doing and talk about what we're seeing. Remember to ask questions. I'll come back out at the end of this section to answer questions at the end of this presentation. Now, central banks battle inflation while trying to avoid a severe recession or banking crisis. The recession versus no recession debate continues, and sentiment appears to be in favor of no recession, just a soft landing. The expected pause in Fed rate hikes could support stocks. So oil price has rebounded. Remember, oil price is the green line here. And remember what I said is that the one thing that can push up a CPI or inflation, particularly in the US, is oil. The volatility of energy prices is a reason that central banks look at core inflation measures, excluding food and energy. And though if the oil price continues up, it could reaccelerate inflation as it's a key input for many industries. Here we can see the 3-month government bond yield has risen to 5.1%, which is, incredibly high compared to 3%, so almost double in 12 months. Central banks battle inflation while trying to avoid a severe recession or banking crisis. And rates have come up quickly and inflation has come down. So we expect a pause or slower rate hikes from central banks. So my question to you is there going to be a recession? What do you say? Why don't you type your answer in the chat? I'd love to see yes, recession or no recession to try to understand what you guys think. Go ahead and type that in the chat. No or yes. No recession, yes recession. Now, this is the fastest and most aggressive rate hike cycle by the Fed since 1980. After the 0.25% hike in February, the current rate hike cycle became the most aggressive since 1980. Now, the Fed has hiked rates by 5.25% in the current cycle, and this has resulted in massive yield curve inversion. It says yield curve, cure, but it's supposed to mean curve. Now, yield curve inversion has dived deeper. You want to watch for the turn that seems to have begun. All recessions in the US since 1968 were preceded by an inverted yield curve. In fact, part of the research that I'm going to present on Saturday or Sunday at the coffee live event is some of the research that I've been doing in this area to try to understand whether we're going to have a recession or not. The average time from inversion until the recession started has been about a year in the past, which means fourth quarter of this year. How about a recession? Very possible. Now, after the 0.25 hike in July, the market expects a pause in September 2023. The market's pricing in a 93% probability for a pause at the next FOMC meeting. A pause could mean a delay in the recession, and a pause could also be positive for equity markets. Now, the expected rate curve has shifted up significantly. Here we can see that it was down, that dotted line was down at 4.5 and 3.1, and that's now gone up to 5.6 and 4.7. The market thinks the rate will peak in fourth quarter 2023. And falling rates typically have an expansive effect on the economy and vice versa. US is now at peak unemployment, and that puts upward pressure on wages, which is inflationary. On the flip side, a strong labor market can keep the recession at bay. And while composite leading indicators are below the trend, they turned up recently. This composite of indicators is still below trend, but turned slightly more positive recently. Now, you could argue that maybe the world is in a recession already, given that move. The current market sentiment appears to be in favor of a soft landing and no recession at all, which could support equity performance. Now, valuation has risen as price has rebounded year to date, but still is below one standard deviation. World stock valuation is now about its long-term average, and the consensus net margin has come down a bit, but analysts continue to be positive, and recently they revised up. Now, for the past year, we've said that we think the course will be eventually reversed. And we still expect central banks will reverse this course when something breaks. The massive rise in rates will eventually break something. When the news turns negative and markets and economies start weakening, we expect the Fed will reverse course and bring rates back to near zero. This reversal could support the U.S. market, and it's part of the reason why we don't want to be completely out of the U.S. market. If there is an announcement that the Fed is going to support the economy, support the market, then that could be positive for the market. Now, the U.S. stock market can show resilience, and U.S. techs remain strong. we're raising our target allocation to 25% from 5% in AWS. The US is then about 30% of our total equity allocation, which is significantly below the neutral 62% weight in MSCI all country world. A soft landing appears to be priced in, which constitute a risk if the Fed fails. Earnings for US companies have surprised on the upside and have been upgraded continuously. Now, this is important because it shows that there's still earnings there. That's very different from the dot-com bubble. And I just want to talk about that for a second. So people do ask, are we in a bubble? Is this like the dot-com bubble of 2000? And my answer to that is that it's hard to be in a bubble when your earnings are rising. And what you really want to watch out for is when the PE ratio goes to the moon. That's the problem. All right, let's look at some more of your questions. Hold on. So Chris says, all-weather investment theme on which period that listed companies will literally generate the revenue. I guess it might be 2030 that many EU countries will mandate some restrictions in some product processes. Supercorn says yes. Yes. Let's have dinner. Yes. You don't bet in gold anymore. Will gold go below 1800 in the next few months? Now, gold is typically not doing well when interest rates are high, as it's a non-yielding asset. So though inflation and uncertainty can support the price, as sentiment seems to have improved, gold may not see a significant price rise in the next 3 months. We still think it can protect on the downside, some protection there, but the bet on the upside is a risk. Ty, good to see you. All right. Prem, good to see you. And Rainer says, British politicians in Ginza, Tokyo, Japan, if this is a recession, we like one too. Yeah. All right. Another one. First quarter, second quarter next year, but not sure possible before U.S. election. So, all right. And here we can see all-weather theme despite U.S., which country is most likely to lead or make an impact environmental policy to the other. I'm very careful about investing in environmental policy, mainly because it costs a lot of money. And I have a fiduciary duty to my clients to try to maximize the return. And I generally have looked at ESG as underperforming strategies. And so I generally don't pay a lot of attention to it. The other problem is that mutual funds in Thailand they don't have a swath of foreign environmental funds. Yeah. David says, doesn't matter with AWS. Right. With AWS, we just try to stay the course. Rainer says, how does geopolitical developments influence or affect your portfolio construction? I have to admit that it doesn't affect it that much. There's a little bit of an override, but we've developed a model that we've been using for years that's a combination of fundamentals, valuation, momentum, and risk. And from that combination, we're coming up with what we think is the most attractive market or sector. And then ultimately we invest in that. Now, usually the market is already discounting political issues. And so we don't get too fancy there. Pear Wow says, hi, could Andrew please share your view on tech trend and Korean index? I haven't looked at Korea recently, but I think that tech companies have risen so high, so fast, that at some point, they're no longer going to be that attractive. In other words, people are going to switch from growth to value. And U.S. bond bull or bear once rate peaks in fourth quarter and when remain high, longer in first quarter. I think that One big risk is inflation gets out of control, and then bond yields on the long end in particular are not going to come down, and short-term rates aren't either. And so I would say at this point, I think that interest rates are either going to be flat for a while or start to come down in the longer term. And therefore, I would argue that bonds provide an interesting trade. Now, remember, we don't put bonds in the portfolio because we're betting on the upside. We're putting bonds in the portfolio to try to protect the downside. All right, let me continue on. I'm going to switch back into the presentation. So ECB seems open to a pause given relatively weak economic data, and EU companies are resilient. They're used to operating in a sluggish environment. And being a global leader in industrial automation, the EU could benefit from reshoring. Investors have low expectations for the developed market economic outlook, and we see a chance for the region to surprise on the upside, which is why we keep 25% target allocation. Remember that investing is not just about what you think is going to go up. It's about the market's perception of what's going to go up versus what's going to go down. And so in finance, we're looking at the second and third derivative to try to understand how is the market going to react to the different things that we see. All right, let's continue on. Now, small caps typically perform better in a recovery, and Europe appears attractive, and smaller companies generally have better growth prospects and are more agile in capitalizing on new opportunities. We have a 3% allocation to Europe small caps in Alpha Focus. Japanese companies have been hoarding cash over the decades, now sitting on 2.2 trillion, which is 44% of GDP. It's incredible what they're sitting on. High inflation in Japan means the private sector is pushed to spend and invest. Higher inflation can lead to private investments and higher consumer spending, not to lose that purchasing power. In other words, buy now. We keep a 25% target allocation to Japan in AWS. Now, Latin America is something we haven't looked at for a while. It trades about 2 standard deviations below its long-term PE. Brazil and Mexico account for about 90% of that weight. Both countries appear to have gotten inflation down, even if Mexican inflation has decelerated slower. So we add a 3% target allocation to Latin America. I believe that's the first. Now, demand for care and drugs is independent of economic conditions. Medical procedures that were delayed due to COVID now drive demand. And we keep our 17% target allocation to world healthcare in Alpha Focus. Now, there's strong momentum in tech. What we can see is much of the year-to-date recovery in the U.S. market has been driven by tech. And we think that momentum drive by the positive AI sentiment can continue and have a 3% allocation to world infotech. That's in Alpha Focus, and 5% in Inflation Guard. Infrastructure is defensive, and we keep our allocation at 17%. It benefits from government green energy security, and other green energy infrastructure. Typically, predictable cash flows and able to push through costs from inflation. Now, bonds are typically a safe place to be. They're not an instrument that we're trying to trade the upside. Global bonds should provide diversification benefits to the portfolio, and we're switching to global bonds. So in recessions, safer assets like government bonds typically perform well. And though with high inflation, low yields could still lead to negative real returns. We generally don't allocate to bonds to speculate on the upside, but rather use it to protect capital over time. Now here we can see that 250-day rolling correlation. Government bonds should bring diversification benefits to a portfolio. We analyzed 10 bond funds, and the 3 in the chart looked most suitable. And Master Fund C is highly correlated to world equity. So it wouldn't really help in trying to get the diversification benefits. Now, SEB GLOB has more exposure to government bonds compared to the Master Fund B. The previous page shows both funds have a relatively low correlation to world equity, which is pretty amazing because they should have some more connection. So the master fund for this SCB Global Bond Fund is the global aggregate bond fund run by T. Rowe Price with an AUM of a half a trillion dollars. SCB discretionarily hedged FX, and as of July 2023, the hedging ratio was about 40%. And they currently charge front-end fee of 0.54 and management fee of 0.92 per year. Now, energy prices have come down, though the oil price raced up above $80 in August. Food prices have softened but rebounded in July. While commodities have rebounded, it's too early to call the turn. Energy prices, especially European natural gas, collapsed, though the oil price raced up about $80 per barrel in August of 2023. Saudi Arabian and Russian cuts keep feeding through and could keep supply tight. And if demand is sustained, there could be further upside in oil prices. Food prices have been softening, which is good news for humanity. Commodities have rebounded, but too early to call. The global economic growth outlook remains uncertainty, and the main upside in commodities would come from a supply shock, adverse weather conditions, or significantly higher demand. We have a minimum 5% allocation in AWS and no allocations in Alpha Focus and Inflation Guard. Now, central banks have been loading up on gold. Let's take a look. We can see 1136 in 2022. That's a massive increase in the amount of gold. And the recession risk still remains, and in general, gold protects value in times of uncertainty and market downturns. And of course, central banks' aggressive rate hikes and QT could crash the market. Poor EU, US, Japan markets would hit AWS. A better overall sentiment could lead to underperformance of defensive sectors. Now, before we get into Q&A, the Valuation Masterclass Bootcamp 12 starts on November 6th. Our limited super early bird price is still available. And with Phenomena, you can save $100 extra. So get the extra $100 off on any special price point until October 27th. You're going to save $800. Use that coupon code Phenomena and go to valuationmasterclass.com/bootcamp. All right, it's time for any final Q&As. You guys may notice that I get tired at night because I wake up super early. All right, let's go through. Children Pot says, since you believe we're going into a recession with high current rate, why do you keep the position of bonds at only 5? Well, remember, we had a synchronized collapse in stocks and bonds in the past. So at this point, let's say it's a challenge, because I think in my heart, I believe that the Fed is going to have to drop interest rates back almost to zero. So it is something that we've been debating about. So I appreciate you highlighting it, and we'll look into that. There's the details on the Valuation Masterclass, which Alex put in there. I locked some profit by switching out from MSCI All Country World Index last night. Is it a good timing to switch back in? Well, as you can see, I am increasing my U.S. weighting. So, and I've never really had a strongly negative view on the U.S. I just think, on global markets. And so it's just the U.S. that's pretty expensive. So I think that's it for questions. Any more questions before we wrap up tonight's session? All right. if we don't see any more questions, I just want to thank everybody for attending and lots of good questions that we've got. And I hopefully will see you on Sunday, where I'm going to be live at Coffee Works Experience Center on Sukhumvit Soy 26. I think we can put the details in the chat and in other locations. So if we don't have any more questions, I'll see you all on Sunday. Have a good dream. Have a good night. Hug your kids. Hug your wife. Hug your husband. Hug your mom like I hug my mom today. And appreciate every day. Remember, when we are investing, we're setting long-term investment strategy. It's great to see everybody, and I'll see you on Sunday.